Fusion Mobile, quality e-learning experience on the go.
Elements of national income accounting. National income accounting can be defined as ways or means of computing or determining the money value of the total volume of goods and services produced or the total income earned in a given country over a period of time, usually a year. Major national income concepts. The following are the major national income concepts, and they are: 1. The gross domestic product or GDP. The gross national product, that's the GNP, the net national product, NNP, the national income, the personal income, the per capita income, the real income, and the disposable income. The gross domestic product. The GDP may be defined as the total monetary value of goods and services produced in a country at a particular period of time. In calculating the GDP of a country, no account is taken of what it took in producing the goods and services and the nationality of those that produce the goods and services. It is used as an indicator in determining whether the country concerned is experiencing economic growth, decline, or stagnancy. The gross national product. The GNP may be defined as the total monetary value of goods and services produced in a country, including the net income realized from the country's investments abroad. In calculating the income from abroad, the earnings of foreigners from their domestic economic activities in the country are excluded. One thing with GNP is that it takes care of the total monetary value of all the goods and services produced by the citizens of a given country. The net national product. The NNP or net national product may be defined as the difference between GNP and the depreciation that occurred in the period under review. That is, GNP minus depreciation is equal to NNP. The deduction made from a country's fixed capital as a result of wear and tear is what is known as depreciation. The national income. National income may be defined as the total monetary value of all goods and services or the total income earned in a given country over a period of time, usually a year. Personal income. Personal income is the income or amount of money earned by individuals or households over a given period of time. It is calculated by adding to national income the incomes received by households but not earned, and subtracting incomes earned but not received. Incomes received by households but not earned include transfer payments, interest payments, while undistributed profits, contributions for social insurance are included in incomes earned but not received. After all these additions and subtractions to and from national income, what is left that gets to pockets, individuals, and households is known as personal income. The per capita income. The per capita income or income per capita may be defined as the total GNP of a country divided by her total population. It gives you the average income in a country, and it serves as an economic indicator of the level of standard of living and development. Therefore, what per capita income in a given country will be, whether high or low, depends mainly on the available resources and the total number of people in the country. An increase in GNP of a country does not necessarily mean an increase in per capita income and vice versa. However, per capita income does not always give the true picture of the levels of the standard of living of the people and development in a country. This is as a result of the fact that it does not take account of income distribution and pattern of ownership of assets, which generates part of people's income. The real income. Real income may be defined as money in terms of goods and services it will buy. It is the national income expressed in terms of general level of prices. Lastly, disposable income. It may be defined as the income or amount of money that is left to an individual or household for spending and savings after the deduction of personal income taxes. When taxes are deducted from an individual's personal income, what is left is disposable income, which can be spent or saved by the individual or household concerned. Factors that determine the national income of a country. The following are the factors that determine the national income of a country. 1. The nature of factors of production. The amount of capital available, the quantity of the labor force, the fertility of the land go a long way in influencing a country's national income. 2. Available of natural resources. A country with abundance of natural resources will experience increase in national income than a country with little or no natural resources. Level of technology. The higher a country's level of technology, the higher its national income and vice versa. This is also known as ceteris paribus. Industrial development. Industrialization also influences national income. The presence of industries or increased industrial activities can contribute positively to national income. Working population. A country with a high working population is likely to increase national income than a country with a little population. Economic situation. Economic stability rather than economic depression plays a crucial role in increasing a country's national income because it guarantees meaningful productivity. Nature of factors of production. The availability of the factors of production such as capital, labor, land and entrepreneur will enhance the national income of a country. Political situation. Political stability in any country can contribute positively to national income, while political instability reduces it. Methods or ways of measuring national income. There are 3 methods or ways of measuring national income, and they are 1. The income method, the output method, and the expenditure method. The income method. This is the total monetary values of incomes received by individuals, business organizations, government agencies, and which are calculated. These incomes include all interests, salaries, rents, and profits received and made in a given period of time, usually a year. Output method. This is a method of calculating the monetary value of goods and services produced in a given country in a period under review, usually a year. In calculating the national income through the output method, care must be taken to avoid double counting of the outputs of all the sectors of the economy. The expenditure method. This is the calculation of the total monetary value of expenditures on goods and services by governments, individuals and organizations within a country in a given period. In this calculation, expenditure on intermediate goods and services bought and used for further production must be excluded. Reasons for measuring national income. 1. It shows the standard of living. This means that national income gives an indication of the standard of living of the country through the measure of per capita income. It determines the growth rate of the country. National income helps the country to determine the growth rate of the economy. Contribution of international organizations. The national income figure determines the country's contribution to international organizations for comparing standards of living with other countries. The per capita income, which is obtained from the national income estimate, is used to compare the standard of living of a country with that of other countries. Economic policies and planning. The national income estimate is vital for economic policy and planning. It gives pattern of expenditure of households. The national income data give an idea of the pattern of expenditure of households. And lastly, performance of the various sectors of the economy. Measured through the output approach, it enables the country to know the performance of the various sectors of the economy. Problems of computing national income. The problems that can be encountered in the measurement and compilation of national income in Nigeria include insufficient technical experts. This means that the technical expertise, which is an essential element for collecting and analyzing data, is insufficient. Problem of double counting. Some goods can be counted twice, and this gives false national income estimates. Subsistence production. The predominance in the Nigerian economy of subsistence agriculture makes estimation difficult. Problems of inflation. The national income figures can be over or underestimated as a result of inflation or deflation. Inability to quantify some services. Some services are not easily quantified, thereby affecting the national income estimates. Difficulties in estimating net valuation from abroad. It is very difficult to estimate the value of net income from abroad. This is because many individuals may be involved, hence making accurate assessments impossible. Improper valuation of depreciation. This will be affected by the valuation of depreciation on capital stock. Ignorance and illiteracy. High level of illiteracy and ignorance gives incomplete and false estimates for national income accounting. Incomplete information. The income returns are inaccurate and incomplete. And lastly, illegal transactions. Certain illegal transactions like drug peddling, smuggling, make computation of national income very difficult. Limitations of the usefulness of national income statistics. The following are the limitations of national income statistics. 1. Differences in method of computation. The use of different methods of computation of national income by different countries makes it difficult to have a common basis for comparing nations. Differences in structure of production. Where subsistence production exists, output is more likely to be grossly underestimated than a country with a market economy. It do not reveal income distribution. This means that national income estimate does not indicate whether income is widely spread or concentrated in a few individuals. It leads to changes in population. The size of national income may not itself be a true measure of economic welfare because of changes in population. Differences in internal value of money. The differences in the internal value of money make it difficult to compare the standard of living among nations. Differences in priorities. Different countries have different priorities in terms of expenditure on output, and this makes it difficult to compare nations in terms of standard of living. Differences in national needs. Differences in the needs of nations makes it difficult for national income comparison. Cost of living can be defined as the amount of money an individual spends to obtain the goods and services which will sustain him at a particular time. It is the money cost of things as food, shelter, clothing, medical services which the individual consumes. The cost of living depends largely on the prices of goods and services, which means that if prices are high, the cost of living will be high, since the individual will have to spend more money to obtain goods and services. But if the prices are low, less money will be spent, hence the cost of living will be low. Standard of living. This can be defined as the level of economic well-being or welfare attained by individuals in a country at a particular time. The level of welfare is determined by the quantity and quality of goods and services consumed within a period of time. The higher the quantity and quality of goods and services consumed, the higher the standard of living, and vice versa. The income per head and the distribution of income are used in measuring the standard of living. relationship between cost of living and standard of living. The cost of living, as we explained above, largely depends on the prices of goods and services which are consumed, which means that if the prices of goods and services are high, there will be an increase in the cost of living since people have to pay more money to get them. While if the prices increases, people purchases fewer goods and services, they therefore consume less, and this results to a fall in their standard of living. On the other hand, if prices of goods and services fall, people will be able to obtain them in greater amounts. This means a fall in the cost of living. They would also purchase high quality goods and services, and this will increase their level of consumption and their standard of living will increase.